Welcome to the debate. The corporate landscape is really shifting quite dramatically right now. Amazon is set to cut up to 30,000 white-collar jobs, and this is sparking a really crucial discussion about the impact of artificial intelligence on the future of employment. We're examining data compiled by NotebookLM today to try and understand the underlying economic causality here. The core question we're really digging into is this. Does this massive wave of corporate layoffs, exemplified by Amazon cutting 10% of its office workforce, does it truly signal irreversible productivity gains driven by AI? Or is AI just serving as a kind of convenient organizational cover story, a perfect alibi maybe, for market corrections following that huge post-pandemic overhiring spree? From my perspective, I believe the evidence points pretty squarely toward AI being the fundamental catalyst here. It's forcing a structural and, frankly, permanent redefining of the white-collar labor market, just as, corporate leaders have predicted.
Yeah, I think I come at it from a slightly different angle. While I certainly don't doubt AI's long-term power, I'm more convinced that the immediate, very visible cuts we're seeing right now are primarily driven by financial and organizational necessity. AI is obviously a powerful technological development, no question, but it also seems to be a very convenient scapegoat. Something used to mask maybe organizational bloat and correct for that frenzied overhiring that happened during the COVID boom.
Okay, let's maybe establish the scale and the focus of the shift first. Amazon's plan, cutting 30,000 corporate jobs. That represents a pretty strategic culling of previously secure, high-value sectors. We're talking core areas like cloud computing, AWS, HR, even internal development like video games. This isn't just incidental trimming, It feels like a strategic reduction based on some clear operational projections. Amazon CEO Andrew Jassy was quite explicit. Generative AI will lead to fewer people being needed for certain tasks. And analyst Sky Knapps seems to support this, affirming that Amazon is, quote, realizing enough productivity gains through artificial intelligence to justify this substantial headcount reduction. And look, this isn't just an Amazon quirk, right? We see Meta, Google, Microsoft, Salesforce. They're all redefining priorities around artificial intelligence and, at the same time, shedding staff.
It suggests a really profound, maybe permanent change in how intellectual capital is valued and deployed. Historically, this does align with the more pessimistic view of technological unemployment, where the creation of new jobs simply doesn't keep pace with the swift automation of intellectual tasks. This transition, it's going to demand a massive, probably painful skill shift, forcing a redefinition of the future middle class towards those high-level cognitive, social, and technological skills.
See, that argument rests very heavily on CEO rhetoric and future projections. But I'm sorry, I don't fully buy that the immediate trigger for these specific 30,000 layoffs is purely technological inevitability today. The timing, as I mentioned, it really suggests financial opportunism and correction. We know that Amazon and its peers, they significantly ramped up hiring between 2020 and 2022 during that whole e-commerce surge. So the current cuts feel much more like a classic market adjustment after that, unsustainable expansion. And the material we looked at highlights significant expert skepticism too. Fabian Stephanie from the Oxford Internet Institute, for instance, argues that AI is being deployed as a justification, a corporate scapegoat, or book emissary, as the article put it, to avoid admitting the perhaps more painful truth. We miscalculated 2 or 3 years ago with our aggressive headcount expansion. And crucially, look at the ultimate target of these Amazon cuts. It seems to be management and administrative functions. That points, for me, directly back towards organizational bloat. Reports suggest maybe up to 14,000 managers could be cut specifically to increase the individual contributor to manager ratio by 15%. Now, this structural trimming is projected to save Amazon an immediate $3 billion per year. That $3 billion in tangible, verifiable cost savings. That feels like the clear and immediate causal factor, whereas the precise efficiency gains from enterprise-wide AI, they still seem largely speculative at this stage. It looks much more like classic bureaucratic slimming to me.
Okay, I see why you emphasize the organizational and financial imperative, especially with that immediate $3 billion saving figure. That's significant, no doubt. However, focusing solely on the sheer number of managers, I think, risks obscuring the deeper structural change that AI actually enables. While Amazon is certainly addressing the issue of being overly manager-heavy, it's the technology, I believe, that makes these kinds of reductions possible and, importantly, sustainable in the long run. We know many of these jobs perhaps became supernumerary, managers whose primary task was synthesizing engineer reports that internal systems often check automatically anyway. But the elimination of this inefficiency is, in a way, the first stage of automation. AI provides the efficiency gain that allows the company to cut not just those managers, but also positions in AWS and HR that rely on complex cognitive tasks, following well-defined procedures, which is exactly what AI excels at.
But isn't it more likely that the functions being eliminated are just inefficient bureaucracy that accumulated during those high-growth years? Perhaps. Often due to managers being promoted prematurely, maybe as a retention tool during the talent wars. If the job description being eliminated is essentially redundant middle management, that strongly suggests the primary driver is structural correction to the org chart, not necessarily displacement by a newly implemented AI tool today. We're talking about reducing bloated managerial layers, not replacing every single data analyst with a large language model overnight.
That's an interesting point about retention pressures creating bloat. Yes, though I would still frame the technological application a bit differently. The strategic nature of the cuts, targeting high-value areas like AWS, suggests more than just trimming incidental fat. We're observing companies systematically identifying positions focused on those cognitive tasks that can be, partially or wholly automated. Look at Salesforce, for example. They explicitly replaced customer service jobs, claiming AI could handle, 50% of the work. That's concrete, measurable automation targeting functions that resisted mechanization in the past. These aren't just supernumerary staff, these are core functions becoming automated, which seems to confirm the prediction that AI will directly impact middle-skilled, process-driven, white-collar work.
Okay, but this forces us to really question the credibility of these AI productivity claims right now. Given the massive AI hype cycle we're in, is the reality actually matching the announcements today? Or is the decision to cut really just a bet on future, potentially unproven gains?
Well, the stock market might provide a strong indicator of investor belief, wouldn't you say? Amazon's stock price reacted positively or at least held steady around the announcement. That signals that investors likely believe these cuts are rational and perhaps signal real impending productivity gains down the line. This strategy lets these tech giants align their cost structure with a future where efficiency is driven by automation. They're prioritizing high-margin services and essentially betting on AI to maintain output with far less overhead. So this strategic pivot feels like a rational corporate response to the potential power of new AI tools. Whether the full gains materialize in 6 months or 2 years, they seem to be investing based on the assumption of automation.
I'd argue caution is absolutely warranted regarding that investor optimism. I think we need to look beyond just the external narrative. Internally, there seems to be significant pushback, or at least challenges. One source we saw cited a finding, I think it was from an MIT report, that something like 95% of corporate generative AI pilot projects fail, often due to poor data, lack of integration, and, excessive hype. The widespread effective adoption of AI in complex, large enterprises is reportedly much slower than advertised. Many projects are apparently being abandoned for cost or security reasons. So this suggests the $3 billion immediate financial motivation from cutting management is very concrete, right? While the AI benefits for many complex white-collar tasks are still speculative, maybe still deep within the pilot phase. If the vast majority of internal AI projects are failing or struggling, how can AI really be the primary immediate driver for laying off 30,000 people today? That immediate causality, again, points more strongly to financial necessity, just using the promise of AI as the public rationale.
But we are discussing a long-term strategic pivot, one enabled by a technology that is
demonstrably functional, at least at the task-level automation stage. And this leads us to the really critical consideration, the long-term socioeconomic impact. I still maintain that this time feels fundamentally different from previous technological revolutions. Past machinery primarily replaced physical strength. AI automates intellectual and cognitive capacity. Key economists are now arguing that the compensation effects, the idea that enough new industries and jobs will be created to replace the eliminated ones, are far less certain today. The trend we're already seeing is a kind of polarization of the labor market, impacting those middle-skilled workers the hardest. The risk of intellectual automation is estimated to be incredibly high globally, suggesting a future where perhaps fewer and fewer cognitive tasks are actually needed from humans.
I understand the fear, I do, but I'm not entirely convinced by the argument that this time is different will completely eliminate those compensating effects. Past instances of technological change, think the factory floor, the farm, they show that job creation, while often painful during the transition period, eventually follows. McKinsey's assessments, even a few years ago, projected no net loss of working hours by 2030, but rather a fundamental and, yes, difficult shift in skills. Innovation doesn't just eliminate roles, it creates entirely new ones, doesn't it? We see the emergence of what we might call new knowledge worker roles, positions that blend technology, social skills, high-level cognitive skills. We've already observed this, haven't we, with the rise of roles like data scientists, statisticians, and sectors like banking, compensating perhaps for the elimination of more routine administrative tasks. The job gets redefined, not necessarily eliminated entirely from the economy.
But if the work that is created requires such specialized, high-level skills, which are calling these new knowledge worker roles, then the average displaced white-collar worker, can they transition easily? Maybe not. The net effect for them could be permanent displacement, leading to long-term structural unemployment for anyone outside a sort of cognitive elite. The painful, immediate layoffs at Amazon feel like visible evidence of the beginning of this transformation. The company is acting rationally, I'd argue, systematically reducing headcount in areas where technology has permanently reset labor efficiency expectations. Ignoring this early signal, well, it feels like denying the arrival of this second machine age that leverages AI.
I agree that technology is structural in the long run, absolutely. But we must anchor our debate today in the immediate causality of these specific mass layoffs. The decision to cut 30,000 employees is, I still believe, above all, a reaction to the concrete, measurable need to correct bloated organizational structures and reduce those massive post-COVID costs. Attributing every single layoff solely to AI risks confusing financial expediency with genuine technological inevitability. And frankly, it conveniently excuses potentially poor corporate planning during the pandemic boom years. We have to remain skeptical of the neat organizational cover story when that $3 billion in cost savings is such a clear, immediate financial motivation.
Yet, the decision to systematically reduce the corporate workforce at this scale demonstrates, to me at least, that labor efficiency expectations across the whole tech sector have been permanently reset by the capabilities of AI tools. This is happening regardless of when those tools reach, 100% adoption across the board. The pain is real, and the cause, I argue, is fundamentally structural.
And that pain is, as we've discussed, perfectly aligned with the need to cut potentially supernumerary managers accumulated during a period of overmanagement and rapid growth. Both factors are clearly present, I don't deny that, but the organizational correction feels like the immediate, tangible driver that's enabling the massive scope of this particular cut right now.
Well, whether these cuts are ultimately classified primarily as a market correction or as the start of a true technological revolution, the resulting impact of AI on work clearly requires continuous, nuanced examination from all angles.
Absolutely. There is clearly much more to explore in the material regarding this confluence of technological and financial factors that will undoubtedly shape the future of employment. It's complex.
Indeed. Continue this essential discussion on future changes with Le Podcast de Philip. Please help us reach 2,000 subscribers and do share our podcast with anyone you think might be interested in understanding the strongest arguments on every side of these complex issues.